Hey guys, Tim Hart here. And I get asked a lot of the time, what's a good yield to be buying a commercial property at? So let's dive into that a little bit more and let's start with, first of all, what is yield for a commercial property? So it's simply the return that commercial property is bringing in an income compared to what you bought the property for. So there's one formula that we use for commercial property that you need to know back to front, and this is what it is, this is what it looks like here. So it's the value of the property equals the net income divided by the yield for that property. So that's the real focus for us. Now the first one you'll see is the net income on the top line there. So that's the income that this property generates after all the outgoings, the council rates, the water rates, insurance, and all that stuff, but doesn't include your payments to the bank. So it's just sort of your net income from the property if you owned it outright. Now we divide that by the yield. Now this is the return that we want as an investor for this asset. Now probably the hardest thing for most first-time commercial property investors to understand is the inverse relationship between yield and the value of a property. So because yield is on the bottom of that the fraction, then whenever, let's say we had a property and it was bringing in a net income of $100,000. If we had a yield and we were happy as an investor to get a return of say 5%, then that property would be worth $2 million. 100,000 divided by 5% equals $2 million. Now that property might be, have a really good tenant, like a government tenant. It's in a fantastic location in the heart of Melbourne CBD. And as an investor, I think, oh yeah, 5%. I'm happy to accept a 5% return on that property because of the risk that I'm taking. Now compare that to a property that might be in a regional location and it hasn't got a great tenant. It's got more risk associated with it. Therefore, you as an investor might say, oh, hang on, I want a 10% return on this property because it's in a regional location, the tenant's not as good. So therefore, if that tenant is paying $100,000, you've got $100,000 divided by a 10% yield gives you a purchase price of $1 million. Okay, so you've got two properties, one that's in the heart of Melbourne CBD with a great tenant that's paying $100,000, and you've got another property in regional Victoria that's paying $100,000. Yet both tenants are paying $100,000 as rent, but the one in the middle of Melbourne is worth $2 million, whereas the regional one is worth only $1 million. Okay, so that's as that yield decreases, the price increases. Okay, and vice versa. As the yield increases, the price decreases. So it's just something to play around with when you're looking at that formula. But once you get the hang of it, it becomes quite easy once you look at it from an investor's point of view of what return am I prepared to accept for this particular type of property. So let's look at what is a reasonable return. Now, as we went through in the example, it really depends, and it depends on quite a few factors. But some of the main ones are location. So is this property in a really high growth area? Has it got lots and lots of people around it? Or is it in the middle of whoop whoop where there's not many people? That'll have a big impact on yield. Probably the next biggest one is tenant. Have you got Video Easy as your tenant? Okay, they're probably not going to be around too long. I don't know how many Video Easies are left. Compared to if you had, a Commonwealth Bank branch, or you had a government tenant, something like that, that's solid, secure, like an ASX listed tenant is going to be a lot more secure than, a Video Easy or a mum and dad pop operation out somewhere else. Okay, so it depends on that tenant. So that's probably the two biggest factors. The next one you might look at as well is the term of the lease. So if you've got a tenant that's going to be there for the next 10 years, then as a buyer, as an investor, I'm thinking, great, I've got a nice solid 10 years of income for that property compared to a property that might only have a lease that's only got 6 months left. There's a lot of uncertainty. Is that tenant going to leave at the end of the 6 months? I'm not too sure. I'm going to want a higher yield for that property compared to the one that's got a 10-year lease. So it really depends on the property and those factors. But one way to kind of look at it is to take an arbitrary sort of figure. Let's say about 6.5% yield. So as an average, you might look at commercial property at 6.5% yield. Now, Underneath 6.5% yield, so in your 5.5%, you're going to have your more premium properties. So properties that are in great locations, they're going to have better tenants and longer lease terms. When you go above 6.5, you get into your 7.5, 8% yields. That's when you're looking at property that's maybe a little bit further out. Maybe it's a little bit more regional. Maybe the tenant's not as great. Maybe the lease is a little bit shorter. Maybe there's some vacancy, that sort of thing. So you can use sort of 6.5 as a rough kind of guide, and then it depends on the tenant and all those factors as to how far you vary from that. Now, the last thing I want to finish up with is the return on investment. So the yield that you get on a property is the return that it's getting based on the income as if you own the property outright. What I want to look at is what the typical return on your cash or your equity you might get investing in, say, $1 million commercial property. So let's take the example of $1 million commercial property that's it's a 6.5% yield, which means it's got a net income of $65,000 per year. Now, typically most banks will lend about 65% of the value of a commercial property. So $1 million commercial property, they'll lend us $650,000. We need to come up with the other $350,000 as a deposit. And for the example, there's usually around $50,000 of stamp duty and other costs associated with it. So we're going to have a nice round figure. We need to come up with $400,000 in cash to purchase the property. We're going to borrow $650,000 from the bank at 3% per annum. And let's look at what return we actually get on our money. So you can see in the formula here, we've got $65,000 income where we need to take off the mortgage payments. So the mortgage payments are $650,000 times 3%, gives us an annual interest expense of $19,500. So we minus that loan off our $65,000 income, gives us a net income after loan expense of $45,500. Now we take that $45,500, divide it by the $400,000 that we put in, and it gives us a return on investment of 11.375% return per annum, which pretty amazing return. Especially in a market where interest rates are very, very low, and you're getting some solid cash flow return of over 11%. Plus you've got depreciation potentially and the capital uplift of that property over time as well. So you can see commercial property can really yield some high cash flow returns for investors, which is why we love it so much. So if you're interested in investing and learning more about investing in commercial property trusts, please subscribe and head over to activepropertygroup.com.au and register your details, and we'll send you out some more information. And as always, thanks for watching.